Welcome back to Capital Gains, where we're dedicated to helping you make informed financial decisions. Today, we're diving into a crucial topic that every investor, whether you're a beginner or seasoned pro, needs to pay attention to: the 5 common investing mistakes that you should avoid at all costs. These mistakes can have a substantial impact on your financial future, and we're here to make sure you steer clear of them. All right, let's jump right into our first investing mistake, and it's a big one: lack of research and knowledge. This mistake can lead to financial disasters, and it's far too common in the world of investing. Investing isn't a game of chance, it's a game of strategy. It's essential to do your homework before putting your hard-earned money into any investment. Research, my friends, is your best friend in the investing world. It's how you get to know the ins and outs of what you're investing in. Why is this mistake so costly? Well, for one, insufficient research can lead to investment choices that simply don't align with your financial goals. You might end up putting money into something you don't fully understand, or worse, that you're not comfortable with. And when you're in the dark, it's easy to make wrong decisions that can result in significant losses. To put this into perspective, let's consider a hypothetical scenario. Say you invest in a company without understanding its business model, financial health, or competitive position. You might not realize the red flags until it's too late, and you've lost a substantial portion of your investment. So, in conclusion, the lack of research and knowledge is an investing mistake that can cost you dearly. To avoid this pitfall, always remember the golden rule: never invest in something you don't understand. It's your money, and you have the power to make informed decisions. Another critical mistake that you should never do as you invest is emotional decision-making. Emotions can be a powerful force when it comes to investing. Let's explore how emotional decisions can impact your financial future. Investing can stir up a mix of emotions: excitement, fear, and greed. When these emotions take the wheel, they can lead to impulsive decisions that might not be in your best interest. One of the most common emotional mistakes is panic selling during market downturns. Another emotional mistake we need to be mindful of is greed. It's easy to get caught up in the excitement of a rapidly rising investment. But remember, what goes up must come down. Overconfidence can lead to overexposure, and when the bubble bursts, so does your investment. Now, it's not about eliminating emotions, it's about managing them. So, how can you avoid this mistake? One strategy is to set clear investment goals and stick to them. Additionally, having a well-thought-out investment plan can act as a guide during turbulent times. To sum it up, emotional decision-making can be a costly investing mistake, so you better manage them as early as you can before things get out of hand. Next up, we'll explore another fundamental aspect of investing: the importance of diversification. Diversifying your investments can help mitigate risk and protect your portfolio, so don't miss it. Diversification is often referred to as the golden rule of investing. But why is it so essential, and how can it protect your investments? Diversification is a simple but powerful concept. It involves spreading your investments across a variety of assets like stocks, bonds, real estate, and even different industries and geographic regions. By doing this, you reduce the risk associated with having all your eggs in one basket. So, what's the risk of not diversifying? Well, imagine putting all your money into a single stock or asset class. If that investment takes a hit, your entire portfolio suffers. Diversification can help mitigate this risk, making your overall portfolio more stable. Here's an example to illustrate the benefits of diversification. Let's say you have investments in both stocks and bonds. During an economic downturn, while your stocks might take a hit, your bonds could provide stability, helping to offset losses and preserve your wealth. Overall, diversification is a fundamental strategy to protect your investments from unnecessary risks. Now, let's move on to another essential aspect of investing: understanding your risk tolerance. Every investor is different, and what works for one person may not work for another. That's where risk tolerance comes in. It's a crucial factor in determining your investment strategy. Risk tolerance refers to your ability and willingness to endure the ups and downs of the market. It's a personal assessment of how comfortable you are with the potential losses that can occur in investing. Why does this matter? Well, your risk tolerance should guide your investment decisions to ensure you stay within your financial comfort zone. Investing outside of your risk tolerance can lead to 2 undesirable outcomes. If you're too aggressive and invest in high-risk assets when you have a low-risk tolerance, you may lose sleep and make irrational decisions during market turbulence. On the other hand, if you're too conservative with a high-risk tolerance, you might miss out on potential returns. So, how can you assess and align your investments with your risk tolerance? There are various tools and questionnaires available, like risk assessment quizzes, that can help help you pinpoint your risk tolerance. Once you know where you stand, it's essential to build a diversified portfolio that matches your risk profile. At this point, let's explore the final, but certainly not the least, investing mistake. Failing to have a long-term perspective. Investing often requires patience, and it's vital to have a long-term perspective in this world. Let's uncover why this approach is crucial. Investing isn't a sprint, it's a marathon. A long-term perspective involves understanding that markets will have their ups and downs, but they tend to grow over time. Having a long-term strategy allows you to weather short-term volatility and potentially benefit from the power of compounding. What's the downside of not having a long-term perspective? Frequent trading, also known as churning, can lead to higher transaction costs and taxes. Additionally, market timing, trying to predict the perfect moment to buy or sell, is incredibly challenging, even for seasoned investors. To drive this point home, let me share some success stories. Many successful investors, like Warren Buffett and Jack Bogle, have attributed their success to a long-term perspective and a buy and hold strategy. They've consistently outperformed those who jump in and out of the market. In summary, failing to have a long-term perspective is a critical investing mistake. It's essential to think about your investments in years, not days or weeks. By avoiding these common pitfalls, you're on the path to becoming a more informed and confident investor. Remember, investing is not just about money. It's about securing your financial future, achieving your dreams, and building wealth over time. If you found this video helpful, please show your support by hitting that like button and subscribing to our channel. Share this video with others who might benefit from it, and don't forget to click the notification bell so you never miss our future content. Thank you once again for joining us. And remember, knowledge is the key to success in the investing world. Stay informed, stay patient, and stay focused on your financial goals. Until next time, happy investing.